Hello students, welcome to part 2 of Macroeconomics Chapter 5, Government Budget. Now in this session we are going to talk about budget expenditure. Like in the last session we were talking about the receipts. Now here we are going to talk about budget expenditure. Budget expenditure refers to the estimated expenditure of the government during the fiscal year. That is, how much approximately the government would be spending on the various things. So budget expenditure can be divided into two, that is revenue expenditure and capital expenditure. So first let's understand what is revenue expenditure. This kind of expenditure is recurring in nature and it is incurred on normal functioning of the government and the provision of various services. Like for example, salaries of the government employees, interest payment on loan which are taken by the government, pension, subsidies, grants. So all these are the revenue expenditure. An expenditure is a revenue expenditure if it satisfies the following two conditions. First, it neither creates an asset nor it reduces the liability. So by spending on such things, you are not going to create any asset. At the same time, you are not helping in reducing the liability also, which means this kind of expenditure does not reduces any liability. Now, what is capital expenditure? It refers to the expenditure which leads to creation of asset. See, the capital word itself says that when you are incurring any expenses on capital, which means you are purchasing or buying any asset. So it is creating an asset and it is reducing the liability. So capital expenditure is that expenditure which leads to creation of asset and reduction in liabilities. But this is non-recurring in nature. It adds to capital stock of the economy and it increases its productivity through expenditure in long period development programs like we have metros or flyover or bridges or any infrastructure. So example for this, we can take it as expenditure on construction of buildings, roads, bridges, flyovers, etc. So we can say that an expenditure is a capital expenditure if it either creates an asset or it reduces the liability. So how to classify expenditure as a revenue or capital expenditure? As we said, now summing up, an expenditure is a capital expenditure if it is creating any asset or reducing a liability. An expenditure is a revenue expenditure if it neither creates any asset nor reduces any liability. Now, there can also be planned and non-planned expenditure. Planned expenditure refers to the expenditure that is incurred on the programs detailed in the current 5-year. So, in the 5-year planning, any expenditures which are included in the planning structure, then those expenditure are planned expenditure. And non-planned expenditure refers to the expenditure other than the expenditure which are in the current 5-year plan. So when we talk about the difference, plan expenditure is spent on current development and investment outlays, whereas non-plan expenditure is spent on the routine functioning of the government. So it is must for every economy, and the government cannot escape from non-plan expenditure because these are the routine day-to-day functioning of the government expenditure. Whereas planned expenditure arises only when the plan provides for such expenditure. Now, how to classify whether your expenditure is planned or non-planned expenditure? So any expenditure is a planned expenditure if it arises due to planned proposal, wherein planning is already done in advance. Whereas an expenditure is non-planned expenditure if it is out of the scope of the government plan. The expenditure could be also developmental or non-developmental. any expenditure which is directly related to economic and social development of the country or economy, then it is developmental expenditure. And non-developmental expenditure are those which are incurred on the essential general services of the government. So this kind of non-development expenditure does not contribute directly to the development, but it lubricates the wheel of the economic development. And these kind of non-development expenditure, it's not concerned with the productivity of working class. Whereas the developmental expenditure directly contributes to the development of the economy and it adds to the flow of goods and services. So we can say that an expenditure is a developmental if it adds to the flow of goods and services, and if it is non-developmental expenditure, if it is indirectly contributing to the economic development. Now, what are the measures of government deficit? Many a times it may happen that government might face either the surplus in the budget or deficit in the budget. Now, surplus is of course a favorable situation wherein the expected income is more than the expenditure. Then what is government deficit? When the government expenditure exceeds the receipts or revenue in the budget, then it is said to have government deficit or a deficit in budget. Now, this deficit or shortage in the budget could be of three types. It could be revenue deficit, fiscal deficit, or primary deficit. So let's understand these three types of deficit. What is revenue deficit? Now, this refers to the excess of revenue expenditure. From the name itself, we can know revenue deficit, which means that revenue expenditure of the government is more than the receipt. So we can say that revenue deficit is equal to total revenue expenditure minus total revenue receipts. What is fiscal deficit? Fiscal deficit is defined as excess of total expenditure over total receipt. So total budget expenditure minus total budget receipt net of the borrowings. And when we talk about primary deficit, it is the difference between the fiscal deficit of the current year and interest payment on the previous borrowings. Thank you very much.